Hello and welcome everyone to the Power of Passive Investing Meetup. We are thrilled to have you all with us. I know it's nice and sunny outside for those that are local in New Jersey or for those that are outside of Jersey, and we're very grateful that you're joining us. But believe me, you're gonna be very happy you joined us because our guest tonight, Ryan, I forgot to ask you how to pronounce your name correctly, your last name.
It's Daigle like bagel with a D.
Perfect. Okay,
Easy.
there you go. Ryan is gonna do an amazing job. If not at teaching you how to underwrite, then definitely at making the best jokes you ever heard. Trust me. So let me do my regular admin stuff quickly so I can pass the mic to Ryan. So again, this is the Power of Passive Investing Meetup. Let me go briefly through Ryan's bio and then we'll ask him to give more details later on. So Ryan lives in one of the hottest markets out there, Raleigh-Durham area. He is a 20-year veteran of the software industry. He has worked in a variety of startups and small consultancies. His last role was a CTO of Durham-based fintech startup, which he saw grow from 3 employees to 80 during the 6 years he was there. After Ryan grew disenchanted with the returns on his 401k and the stock portfolio, he started looking for the alternative investments, and that's how he discovered real estate. Well, welcome to the real world. That's how I and many other folks have discovered real estate here. So after doing a single BRR style residential investment, he quickly turned to multifamily for its economies of scale and long-term demographic support. As a full-time multifamily operator, he is now a limited partner in over 700 units, and he's a general partner in over 80 units, with his most recent acquisition being a 51-unit heavy value add in Greensboro, North Carolina. Ryan brings the same transparent, process-oriented, technology-centric approach to managing multifamily partnership at Flywheel Equity that served him really well in tech, and he believes that real estate is an ideal investment tool for high-wage technology workers. This is the usual disclaimer. We're only doing it for educational purposes only. We're not selling securities. The rest you can read on your own, but my attorney always asks me to display it, so I always do. Housekeeping, please mute yourself and feel free to post your questions in the chat or unmute yourself at the end and ask Ryan. If Ryan prefers to be more interactive, he will let you know in a few minutes when he will take over the podium. Just give me another minute or so. Well, guess what? A lot of folks are looking for that interaction, and while we want to do the in-person events, and we'll do that sometime down the road, for now it's still virtual because we do host folks from other states, so we want to give them opportunity to meet our local Jersey boys and girls on Zoom. So our next event is networking, so please be here promptly at 7 p.m. Eastern. We will do pure networking the whole hours. We'll have a bunch of rooms and switch people from one room to another. If you need to reach me, this is my contact information. I'm sure many of you know by now. And one final comment, which is also very important. I want to thank you, my new co-host, Matthew Aguino, for putting this together and for helping me organize this meetup and to bring so many new faces to our meetup. Welcome, guys, and I hope you join us for the next event. This is all I have. I'm going to stop sharing and give the full floor to Ryan. Ryan, welcome again, and we're thrilled to have you with us.
Thanks so much, Alina. That was a great intro. It was like I wrote it myself. I just really feel like you know me at such a deep level, so I appreciate that. It was such a good intro and bio that I don't feel a need to add anything else. I'm just going to let that stand, and we can get right into today's topic. So I've been in the industry not for a huge amount of time, 3+ years or so. And in that time, I've noticed that a lot of the talks and presentations that are out there can trend a little bit high level, right? There's concepts, that we talk about, the generalities of multifamily investing, why it's good, things to look for, how to do due diligence, things like that. But they all kind of leave me wanting as far as details and concrete examples. So I really want today to be about you looking over the shoulder of how I do underwriting. Many of you have experienced underwriting yourselves, so you may see a lot of things that differ from how you do it. That's completely fine. This is meant to be really in-depth using a specific tool, which is Michael Blank's SDA. That's short for the Syndicated Deal Analyzer. You can buy it on his site. I'm not getting paid anything to say that. It's the tool that I use, I've gotten most comfortable with. And I would say really any underwriting spreadsheet or tool that you use, there are many good ones out there. I think it's more important that it's a tool you're comfortable with. You learn how to navigate it quickly and efficiently, rather than does it have every single bell and whistle, and is it the most robust kind of tool? So the SDA is the tool that I'm most comfortable with, and I'll be using that as kind of the backbone for today's discussion. The concepts should translate no matter what tool you're using. So I want to make this real world, and I'm going to be using an OM and information on a property that I received a couple weeks ago. And I'm going to have a fresh SDA spreadsheet up that I have in Google Docs. I can share it. Alina, I can send it to you when the class is over for people to poke and prod if they want to kind of digest it at their own pace. And we'll just get started. You mentioned up front about the interactivity, or my desired level of interactivity. As long as you or Michael is handling the questions, I'm more than happy to get questions throughout. It gives me a chance to pause, get a sip of water. So please
Sounds good.
ask them as you go. All
Absolutely.
right. So I'm going to share my screen. I think I'm just going to share my whole screen because there's like the broker OM that I want to use next to the spreadsheet itself. And it's a lot of information. So let me go ahead and share it. Alina, you tell me if it is just way too much information or if I need to increase the fonts.
Looks good.
You can actually read these numbers here on the spreadsheet side.
It's a little small.
A little small, yes, but I was gonna say if I wear glasses, maybe I can see.
How about this? Any better?
That's better.
Okay, we'll go with this. I think most of the information is here. I'll try to not be zipping around from screen to screen and whatnot. I know it can be a little hard to follow. All right, so what I've done, and by the way, I'm sure I'm under NDA for this OM that I have here on the left side. So can we just act like you didn't see it, or be discreet at least with this particular information? I'm pretty sure this opportunity is already under contract, so wouldn't worry too much about scooping in here and trying to get this deal. But okay, disclaimers aside. So when I get an offering, an OM from a broker, the first thing that I want to confirm before I even get into my spreadsheet and go heads down, put my underwriting hat on, first thing I want to do is confirm, does this property align? Does it match my target, my goals, my thesis? Okay. Flywheel Equity, by the way, that's the name of my company. I think Alina mentioned it in that very amazing intro. But yeah, Flywheel Equity, small private equity real estate shop here in North Carolina. We operate in the Carolinas. Our thesis and target is really around the affordability of auxiliary markets around all the great major metros we have in the Carolinas, right? Raleigh, Durham, Charlotte, Greenville, South Carolina, the whole upstate South Carolina area, Charleston, Wilmington. The Carolinas have just these amazing metros, strong growth for a decade plus, and looking forward, no signs of slowing down. But it's the prices in these markets are at a premium, justifiably so. That's not where we play. We like to go a little bit further out into kind of the satellite markets of these major metros. So that's our particular thesis. May not be yours. That's fine. But I think it's always good to acknowledge that you can't just go straight into the numbers. You have to make sure that this is an asset that is going to be something you're capable of doing. So for us, this particular opportunity came across. It is in an area called Rock Hill, South Carolina, which is actually right outside Charlotte, North Carolina. So it matches kind of our thesis. It is a value add property of about 100 units. Vintage, I believe, is, we'll scroll through here. Vintage is 1971. So it's like, okay, we're very familiar with that vintage. We like the market. If you didn't know much about Rock Hill, like say there was another area outside Charlotte that didn't have maybe the name recognition of that Rock Hill does, one of the first things I'll do is I will confirm that the growth of that area is above national average. We like to be right at or above national average in these areas. So the easiest thing to do, there's a site called World Population Review. If you look up here in the URL, I usually just do a Google search, Rock Hill, South Carolina population. It's always one of the top 2 or 3. And I just want to confirm that this area is growing at or above national average. So right here on the right-hand side, highlighting over here, 2020 growth rate of 0.78, basically 0.8%. National average right now is like 0.4-ish or so. It used to be 0.6% a couple of years ago, but the US is declining in its growth rate. So this is a very, very strong growth rate. Because it's less than 1% visually, it may not resonate as being really strong. But I mean, first of all, look at this graph. That's a really solid graph, just going straight up and to the right. And it's about double the national average. So that's a strong area. Also, I know it's right outside Charlotte. Charlotte's an amazing metro. So I'm putting a check mark on the metro and the growth rate as being one that matches my thesis. Your thesis may actually be that stagnant metros have limited supply coming online, and thus the properties in those metros and those areas, maybe you can get more value out of. That's a perfectly fine thesis to have. Just make sure you don't have the shiny object syndrome where every OM that comes across your desk you feel compelled to pursue, right? It has to be in your wheelhouse. Okay, so we talked about also matching the vintage and the number of units, 104. That's great. We would love to kind of go between 70 and 120 units. It's a great economy of scale for us. Yes, 200, 300 would be great as well. We're not quite there yet. This is exactly something that we can do. Good, 2 thumbs up. All right, so I'm gonna go back here to my notes. Step 2 is going to start our spreadsheet work. So here we are in a blank SDA spreadsheet. Okay, this is kind of my starting point. I've saved some numbers, some default values in here, but none of this is specific to this particular property. This is kind of just my starting point. I've modified this a little bit from if you were to download the SDA directly. There's a couple more columns up here for different scenario modeling. I don't find that I use them that often, so I've kind of collapsed it to what are current, aka the marketing package, and then my kind of pro forma stabilized view. So the first thing that we do here is we're going to go ahead and enter what the unit mix is from the broker's OM. And I didn't mention this up front, but this is really kind of first pass underwriting. This is not I'm emerging out of due diligence and I'm going hard with these numbers. This is, am I even close enough to pursue an LOI? Okay, so first pass underwriting, we can be a little more coarse grained, but we want to get a sense of, are we even close to what the whisper price is? So we're going to go in here. This unit mix summary is pretty easy to type in. So we're going to start filling out our SDA. Studio units, they're 24. 1 bed, 1 bath, there are 16. This is like a live demo from my tech days. Hopefully nothing crashes or I don't make a ridiculous mistake. Enter everything in, 104 units there, 104 units represented in the offering memorandum. Looks good. So got our unit mix in. Second thing I'm going to do is go over here to the current rents. I want to capture basically what the current rents are. We're still back here in our unit mix summary from the OM. I guess I can kind of zoom in here, make sure we're looking at it in this area. So I'm just going to go through and I'm going to fill in what the current average rents are. We got 660 for studios, 724, 737, and 866. So real quick aside, do I take the OM as being gospel? Of course not, especially with projections. However, for this first pass, I'm kind of taking the basics from the OM, putting them in the SDA, and we're going to see what comes out. In kind of a second pass, I will go through and just spot check some numbers, right? I'll look at the T12 that the brokers included and compare it to what they had in the OM, and make sure in general that there's no large discrepancies, that the broker hasn't taken some liberties with how they presented the current operating status of the project. So don't want you to think that I'm just going blindly here. So, okay. So this is the current makeup. And what we'll see, so over here on this first column, the first two really, but the marketing package, you're gonna see that the average monthly rent here has been input, right? It comes out with your gross potential income. I have some default vacancy numbers. So another thing about this property is you read the OM, you find that it's actually, because it is value add below market, the vacancies are actually quite low. You also notice that Rock Hill itself is a very strong market. So, I'm certainly willing to kind of go by the T12, which I think is somewhere around here. It's pretty low vacancies. And I'm not really looking to create at this stage an exact replica of the current operating performance of the property in this column. I'm just looking to show what a baseline looks like and then what I think I can get the property to. So for now, we're going to leave this column as is. We've got a 50% expense ratio here. What I will do is I will go back to the OM when I'm looking at current performance. I'm going to scroll past all the good stuff that tells me how many millions of dollars I could make if I increase rent by $400 a month. Okay, that's realistic. So I'm going to keep scrolling to the financials. I want to get to the T12 section. And here we are. So this is, I'm going to assume the broker is pretty much being super accurate here on the T12. I'm just going to look real quick at total operating expenses. Looks like, not including replacement reserves, which I do include kind of as an operating expense. It's 546,000 operating expenses. We're going to add another 30,000 for the reserves, which is what they kind of pro forma. So I'm going to say it's 576,000 on the expenses. So I put that in here. It's actually a little higher on the expense ratio. It tells me there's probably some opportunity here, or this is a poorly managed and or physically deteriorating asset. So that's a little asterisk for me in my head. I'm going to write a note about that to follow up with the broker. Okay. Current state. We've captured the current state. Now, the very next thing I want to do, and most of what I do is value add. I'm not super interested in buying 4 caps that are stabilized. That's not enough upside for me, not enough premium. Maybe for you, great. I would someday love to have an A-class property in some downtown city. That's not where I am right now. So a lot of what I do is looking at what upside can I capture here beyond just organic rent growth in all these great metros of the Carolinas. And so there are 2 components to that I want to find out. One is, if we look over here, I'm back in my spreadsheet, what do I think I can push rents to? Okay. And commensurate with that, how much money am I going to have to invest to get those rents? And this is where you can do a couple different scenarios, but I know that I want to come in, I want to do a really good job and have long-term ownership mindset. So I'm going to pretty much model what's the highest and best use of this particular property? What's the best state that I can get it to maximize on the rents? So to start with, I want to understand, I don't have an intimate knowledge of Rock Hill, South Carolina. So I just want to understand what's the range of rents that I could expect for these various configurations. The tool I use for, again, just a quick first pass is called Rentometer. Many of you may use it before. I think they have a free version, but then I also pay a fee. You enter the address, You enter what you hope to get in rent and then the configuration of the particular unit. Here, I'm going to show you an example of 2-1s. From the OM, they make a claim that there's quite a bit of headroom on these, on the rents, especially if they're renovated. So I think, as we saw earlier, the average rents were, sorry, the Zoom window is kind of hiding my toolbar, so it's not, okay, yep, so we're in the right spot. So average rents for 2 bedrooms, $737. I think the OM said you could go $250 easily. So as a starting point, I'm just going to say $900. Is a $900 2-bedroom, 1-bath in Rock Hill near this area, is that a reasonable rent? Actually, it turns out, yeah, that's actually it's a good rent. I don't know, this little dial here is not the most intuitive visual representation of whether 900 is good or bad, but green, the arrow being on the left side and green means it's actually good. It's more useful here, the average, the median, 25th percentile. So even the 25th percentile rent for a 2-bedroom in this area is almost $950. So there's some good upside here. What I have found in the types of renovations that we like to do is that we'll often get 75th percentile and above rents in our area, because we do like to put a lot of effort and make our renovations complete, not just lipstick on a pig. We do it right. Sometimes we do LVP throughout the whole unit. That's our process. Maybe that's not as far as you want to go. Maybe you're approaching yours more as a flip, and so you want to have a little shorter term mindset. Nothing wrong with that, right? But that might go into your adjustment of how high do I think I can push the rents. So I'm going to say we can come a lot closer to $1,000. Let's just call it 975. So I'm gonna go over here, 2-bedroom. I'm gonna change that to 975. So that's about a $250 rent bump post renovation on a 2-bedroom unit from what I'm getting today. Already, that's telling me something. You don't find those kind of deltas very often. So that's telling me this is a pretty meaty, heavy value add. There's a big delta here between market and what the current operator's doing. Again, that could mean many things. It could be an opportunity. It could also mean there's a lot of hair on this one. So again, that's you're starting to, as you go through this, you're starting to understand and get a feel for the nature of this kind of property. So if I go through Rentometer, do the same thing for the various other units. I'm going to cheat here because I think I already did that. 775, 925, 775, 925, and 1200. If you just take my word that Rentometer, I'll also go on apartments.com, although for first pass underwriting, I'll probably just stop here if I really need to dial it in. If I'm close on valuation, then I will kind of go back in and dial it in and pull up some other comps. But for right now, we're showing pretty good deltas between our current rents and what we think we can get. Okay. So at this point, I go and my income for the current status is here, about 867,000, and my target income is also filled in. The only exception here being the vacancies. Again, in an area like Rock Hill outside of Charlotte, I am willing to kind of go 5-2. The split isn't that important, physical and economic vacancies. It definitely would take a really high quality property and a high quality area for me to go less than 7 or 6% total vacancies. So I'll usually start at 7, and that's a good baseline for me. Okay. Other income, can't forget that. That's an important line item. Looks like currently they're at 20K. So we want to give them credit for that. We'll put it in there for both. For now, we'll just assume we're getting somewhere around the same. All right. So we see our net income could go from 885 to 1150. What is that? About 275K or so. That's a pretty juicy bump in top line. So there's a lot of room on this property. Now, the question is always, how much am I going to have to invest to get those numbers there? Okay. And then this is where there's a little more nuance and, some experience comes in, but I can give you some kind of buckets and rules of thumb that I use. So you have to get an understanding of what does the property need. In this OM, they actually do a pretty good job talking about the value add potential. I'm not going to make you all read all this, but basically the summary from the broker is something to the effect of, this is a not updated property, but well maintained, right? Roofs have been maintained, asphalt's good, HVACs are regular replacement, like all the structural fundamental stuff is has been maintained. It's an owner that lives 2 miles away, so it's not an absentee owner or anything like that. This is somebody who cares about the property. They're doing their best. They've just had it for so long and at an amazing cost basis that they're not super motivated to renovate and to push rents. So that's great, right? It says most of the money that I'm going to be able to put into the property will go towards items that are going to result in rental upside, as opposed to a new roof that may be something you have to do, but it doesn't necessarily result in rental upside. So I kind of think about the CapEx and the renovation in terms of buckets, right? If it's basically just a light turn or a normal turn of a C-class property, I might say $2,500 a unit. If I'm looking to do kind of a mid-level upgrade, maybe I'm going to clean the carpet, maybe I'm going to do some paint, maybe there's some flooring work that needs to be done, maybe an appliance or two needs to be upgraded. That's more like $5,000 a unit. And then 8,500 plus a unit is kind of my bucket for, I'm going in and doing what I consider to be our kind of standard upgrade. It's new flooring, it's new appliances, refinishing and resurfacing, it's new vanities, resurfacing tubs, things like that. The unit's going to feel, it's going to be a 1970s property, but it'll feel upgraded. And that's when we can get rents that actually exceed median for the market. So in this property, I am going to assume that $8,500 bucket. Okay, so what I've done here in the CapEx line for my projection, my pro forma, is I went in and I said, basically made it a formula of the total number of units over here times $8,500. Okay, that's interior rehabs. Usually in a property like this, even if it's been well maintained, there are other things you want to be doing, whether it's maybe amenities or painting or things like that. So I'll usually do maybe some percent of the purchase price as like an additional buffer for the non-interior upgrades. Again, we're just looking to get to an estimation of what we're going to have to invest in this property. So I might do something like purchase price times 5% or something like that. Or if I just want to hard code it, I'll do 8,500 per interior plus maybe 150,000. This is a bigger property. If it's a smaller property, I might just do 50,000, something along those lines. Okay. So we see that our CapEx reserves need to be around $1 million to upgrade this property. And for the investment of $1 million into this property, I'm hoping to bump rents, about $225, $250 across the board. So at what price does that make this a good deal? Is the next question, right? And by the way, at this point, I'm not going to go too deep into the expenses because it gets a little boring line item by line item. 48% for 100 unit or so that you're going to go into every single unit. That's probably somewhere plus or minus 3 or 4% where you're going to actually end up. There's a huge variance to the expense ratio on these projections anyway, but I'm comfortable with that kind of being my assumption. At this stage, I'll leave it there. I won't go line item by line item on the expenses. All right.
Ryan, can I pause you for a second and maybe ask you to expand on I know myself and others looking at deals, estimating those budgets that you threw out is a challenge, right? And I'm curious, the numbers that you threw out, are those through your personal experience, doing involved other projects? Are those sourced from like an estimated dollar per square foot or some industry standard you use? I'm just curious, like how, or do you do a bottoms up on every project at some point? Or this probably isn't at that point, but I'm just curious, like those numbers correct, because that could make or break a deal, kind of just a couple thousand per unit.
Sure. Those numbers are based on my experience with assets of a similar vintage and size. And also keep in mind, you're as far as your cone of uncertainty, you're at the top, right? You're at the point of widest variance. And so you're looking to see if your underwriting comes within 10% of the purchase price or the pricing guidance. If so, you're close, and then you can put more effort into really get into it. You're going to do a site visit. That's when you're going to see, oh, wow, this property has X, Y, and Z additionally, or I would have never seen that. I need to get an actual estimate because I'm not familiar with that type of thing. So in this particular example, it's personal experience from a very similar type of renovation.
Prior to you gaining that personal experience, did you, how did you, I guess, get some numbers to toss into the models?
Yep. Called and talked to property managers that had that experience and that would be doing the turns and the renovations, and that we were ultimately responsible for managing those renovations. And then also building in a decent sized buffer on the first time or two, right? So leaning on the experience of others.
Yeah, that makes sense. Thanks.
Right. So almost every OM these days from the broker doesn't have a price on it. Well, welcome to a seller's market, right? So I actually called the broker because I really like this area. I like this size property. It seemed really interesting. Excuse me. And I just got the pricing guidance, and I was told $11 million. So I'm going to go ahead and put the asking price in there of $11 million. So 11 million for 104 unit, that's a little under 100K a unit. Just looking at like the sniff test that you can, when you've underwritten a lot of these, as I'm sure many of you have, there is a per unit price to rent potential ratio that if one is, if it's anything close to the 1% rule, like you're used to in rental, single family rentals, you're like, oh, that's interesting because so many times it's way below 1%, right? So if 100K unit rents for $1,000 a month, 1,000 divided by 100K is 1%. A lot of times that's a decent deal. Okay. So in this case, it's like, okay, they're asking for, I think it's maybe 96 a unit. Oh wait, no, they're asking for 105K unit. So you're like, okay, 105K unit for what I think an average rent could be of 973. It's like, okay, that's close to 1%. However, I had to invest a lot of money to get there. So right away, I'm like, all right, this is this market. I'm not super surprised by that, but it's feeling like this is not exactly a great price coming out of the gate, but that's why we negotiate. So there are some kind of early signs that you can get. And a lot of times if you're way off from kind of the ratio that you're used to seeing for deals that work in your area, for your market, for your vintage properties, for whatever your thesis is, you'll start to formulate kind of guardrails like this. So for me, it's like, okay, close enough, seems to be a bit of a premium, but maybe we can get there. So I'm going to continue going. If it were way off, if it were, they're asking 100K a door and rents are $800 or rents could be 800 and it's going to take me $1 million to get there. A lot of times, especially if it's coming from a regional or national broker that I know is being marketed out to everybody, I'll move on pretty quickly. So there are these milestones that you'll find for yourself that will kind of help you make the process more efficient. But we like this one in general, and I don't want to cut you off already on the meetup, so we're going to go ahead and pursue this a little bit more. So you see here that the purchase price, I think I have some default in there based on cap rate. I'm just going to assume I'm going to pay full ask on this. I'm going to enter in 11 million for the purchase price. Eventually it will update. Okay. Now, let me refer real quick to my notes here. I kind of glossed over expenses. One thing that I will do is go down to the T12 and pro forma section here. And I will go line by line and see where is the broker assuming big increases in efficiency or big reductions in expenses. If I go, existing payroll to what they think payroll will be, G&A to what they think, line by line, I'll go through and I'll see if anything stands out to me. Two things that stand out here. One are that turnover and R&M totals about, if I'm doing my math correctly, super on the spot, almost a 120K, 118K. And their pro forma has 67K. So currently they're spending twice as much on R&M and turnover as they think they will in just year one, your year one pro forma. Seems suspect. I'm going to assume that the current owner isn't purposely throwing money away. I'm also going to assume that I can't just go in and on day one snap my fingers and just wish away 60K in annual expenses. So I'm going to ask the broker about that. What went into that assumption? This broker actually did a really good job talking about their assumptions here in the next section. So I won't dive into that. I'm just kind of showing you what stands out to me. The other thing was out around insurance, 81K versus 36K. I know from general experience, again, depending on the condition of the property, $350 per unit per year in insurance expenses is actually, that will cover a lot of aged properties that may even have issues. So that tends to be my high side of what insurance costs will be, $350 a unit per year. So 81K is very, very high. So I want to understand more about that one. I actually talked to the broker about this, that they switched insurance companies. So they had paid off 1 year on their old company, and then they paid forward a year on the new company. And they just hadn't gotten their prorated refund back from the old one. So it's actually not as bad as it looks. But these are the types of things that kind of jump out to me when I'm looking at the expenses. So they think the operational expenses can go down to about 498K. We're going to give them credit for some of that. So let's go ahead and override. Let's call it 525. Don't want to give them full credit. Brokers are good at selling, not operating. We have to operate it. So we're gonna build in a little fudge factor there. Again, this is coarse grain stuff. And we see that that's still a 45% expense ratio. So we're not making assumptions that are Goldilocks-y, right? These are 45% expense ratio is reasonable for a 100-unit property. So we know that we're still in bounds. Okay. So at this point, I want to know, I've kind of entered my reality. I've entered the current reality, and I've entered what I think I can do with this property, what that upside is. As you've done this a few times, this may have taken 5 or 10 minutes. You've had to listen to me ramble, so it's taking closer to 30. But there's definitely some compression that'll happen there as you're doing it yourself. The next step for me is I'm going to hop over to my summary tab. Again, this is specific to the SDA, but it's basically where return projections and other deal structure items are housed. And I'll kind of go to the bottom, which is where returns and other items are. I've added this section because these are metrics I care more about. If you've heard me rant before about projections, IRR, other things of that nature that rely on very, very forward-looking estimations, you know that I don't don't feel good about relying on those types of guesses when I'm doing these types of projections or when I'm presenting information to investors. I look more at some fundamental numbers that indicate risk and potential upside with real estate than return projections. But a lot of times they'll be in sync. You're not going to show a 20%, 15%, 12% IRR and have crappy fundamentals. They tend to be in sync for the most part. So I'll take a quick look. IRR returns around 5%, certainly feels a little low. If I look at the fundamentals, yield on cost is way below what I like. Again, this is kind of a specific number that many of you may or may not have heard. I have a few YouTubes on this kind of approach and what these numbers mean. But basically, this deal at this price, it's not close. So, okay, it's a high price deal. Surprise, surprise. What we can do is say, okay, well, what would it take to put an LOI in this property? So usually I'll go and I'll just say, okay, let's take 10% off this deal. That would be 1.1 million. That would be $9.9 million. If I make that my purchase price, and I go back to summary and look at my return projections, again, I'll focus on projections for the purpose of this meetup, and not kind of some of the fundamentals I prefer to look at. Okay, 7% IRR, 8 something annual return, still not great. So it's like, okay, we're starting to stretch this thing. Now, when you get to this point and you're like, okay, is the broker going to accept let's put it at $9 million? Would we, does that even make sense? You're getting closer, you're double digit. I personally feel good about double digit real estate returns with conservative underwriting. But if you're raising money from lots of people, they may have different expectations. It's between Bitcoin and real estate. Who knows what your investors are thinking. This is up to you. It may be that your investment partnership, you may be running a JV, you may have conservative investors. You may be looking for 10% returns in high quality real estate in good areas and with growing metros. That's great, right? Whatever your targets are, that's kind of where you start getting a sense for it. So at this point, say I'm targeting a 12% IRR or a 7% yield on cost or 6.5% yield on cost. We'll think of those as similar. I know I'm still a ways off, and I had to ask for a $2 million reduction in price. I've never seen that in this market. So I know that I really can't come close on this deal. So what are our options at this point? By the way, if there are any questions, go ahead and throw them out now.
Folks, feel free to unmute yourself or just put your questions in the chat.
So at this point, there are a few things that you can do. And this is also where I want to point out like the high leverage inputs into any underwriting, because these are the things that small tweaks can make big differences in your projections and your pro formas. It's also something to be aware of when other partnerships are showing you their projections. If you've done this a few times yourself, you can better identify what numbers they might be tweaking to kind of get palatable investment outcomes. So there are two main areas that I'll look at. One are your exit strategies. So in this one, I've assumed 4% debt, 30-year amortization at 25% down. That's a typical agency loan, kind of vanilla, run-of-the-mill at this stage. You can model, and many people do model, a refinance, right? If I'm driving the value that I think I'm driving in the property, hopefully by year 3 on stabilization, I should have enough to refinance out and return some back to investors. If I put in, hey, cash out refi at year 3, then this section will update. I'll see that I can repay the outstanding loan, and I'll have about $800K in leftovers to return back to investors, We keep the property, they get a little bit of their investment back, the capital account balance reduces, and their cash on cash returns go up. We see that our IRR return projection is still probably not going to pass the muster for most. So that's one thing you can do. I prefer to, when I'm underwriting, I don't worry about refinance unless it truly is like a bridge loan situation. I know it will have to be done. I'll usually just say no refi. I'm going to act like I'm going to buy this and hold it for 10 years. If the returns for just a vanilla 10-year hold, I'm not flipping, I'm not refining. If that is, close to 11 or 12% IRR, that's a great baseline, especially in this market, especially knowing that I have a lot of options available to me, whether it's refining or in 2 or 3 years selling, that has the chance to really boost the IRR. But that's my baseline. Okay. Again, you may have a different take on that, but the point is, this is a high leverage type of input, type of adjustment you can make to your underwriting. In this case, it didn't seem to make a huge difference. The other one, as I'm sure we all know, is the cap rate. So the exit cap rate. When you sell, which in my case, I've input 10 years from now, what might the exit cap rate be? Honestly, I have no idea what the exit cap rate is going to be in 10 years. That's why I don't like to rely on it when I'm looking at the numbers. But what I will do is say, okay, if I were to buy this property at $11 million, I'm here in the kind of the current column, the marketing package. Current NOI is around it's actually around 350. Let's see, 540. I need to update actual expenses here. 546. Oh, I know. I added the extra. I added the replacement reserves. Sorry. Okay, so current NOI is around 310. If I were to pay 11 million for it, that would be a cap rate of 5.75 or so. Actually, I think I might have it here over in the summary tab. Cap rate at purchase, 3.5%. Is that accurate? Scenarios, C48. Yeah. Right, let's do the quick math. 310,000 divided by 11 million is even less. 310, did I get that right? Okay, we're talking about a very low cap rate. So for value add, cap rates are not that useful, but it definitely tells me that we would be paying a premium for this particular property. And I know this is a strong market. So a 6% cap rate, I mean, honestly, I haven't seen a 6% cap rate on a 50-year-old 12 unit, somewhere out in rural North Carolina. So I feel like a 6% cap rate is pretty conservative. So I might be willing to bump this down a bit, right? Maybe say, I believe in the continued fundamentals of multifamily. It's a great area. I can make that case. My investors agree with me. They love the asset class. They buy into this thesis as well. Nothing wrong with that, right? That's a perfectly reasonable thesis. If you had had that thesis for the last 10 years, you would have been spot on and you would have made a lot of money, right? So, you definitely have to be careful with your exit cap rate assumption because it is pretty high leverage. So I think when we made that change, look down here in the IRR, it's right at 10. When we went back to 6, you gained almost, exactly a percentage point in your IRR. That's a pretty big deal, especially over 10 years. So that exit cap rate is super important. 5.5, yeah, I'm comfortable with that in Rock Hill, right outside Charlotte. But I'm still not quite where I want to be. So there's some other things you can do. Maybe you want to increase your pref to members. Maybe I change that to 8% instead of 7%. That didn't really move the needle that much on my IRR, which tells me that maybe there's just not enough there, right? The property isn't producing enough to fully cover that pref. As an operator, I obviously want to know that. So I will always go to the P&L tab of the SDA once I've kind of input everything. And just this is really the source of truth for the projections. So you really want to understand your P&L. After you've input all the numbers, you want to go here. A couple things I like to look at is the preferred return deficiency. So this is the amount that the investors are still owed because their pref hasn't been met, and that amount is accumulating, right? So if you tell them they're going to get an 8 pref, and in year 1, because it's heavy value add, there's little or no cash flow, they're not going to hit that 8 pref. Whatever else they need to make that goes into a balance and gets carried over to next year. I see in this deal that deficiency is increasing every year, which tells me I don't have enough to cover an 8 pref. So no sense in tweaking this number. I can set this preferred return to 20%, and it's not going to change my number because there's not enough there, right? But that is another higher leverage input that you can do if you really like the deal, if you really want to get this property under your belt. Maybe it adds to your portfolio. Maybe you know the area really well. You've already got a team in place. Perfectly valid reasons that you would want to do that. In this case, it doesn't buy me anything. The other thing you can do is maybe you can adjust your equity percentages. The default is kind of 70-30 in the industry, where 70% goes to members, you, the GP, get 30%. Maybe you change that to members get 75%. Well, look, that IRR budged a little bit. 80%, I've seen 80%. I don't get too suspicious until I see something like 90%. That tells me this deal is super thin. The GPs had to scratch and claw to get the investors the returns that they felt they needed. I'd be concerned there's enough there to incentivize the GPs for that, the upside. They're going to work so hard and they're still just going to get a little sliver of it. And it just maybe tells me that the deal is a little imbalanced. So when I'm looking at my own deals, you can play with these numbers, but again, know your boundaries, know what your motivations are, and make your decisions there. You don't want to overstretch it. You're in it because you want to, you need to be compensated for what you're bringing to the table. So I tried these things on this particular deal, and none of them really moved the needle for me. So I'm kind of stuck here, and this is with a $9 million purchase price, which I'm pretty sure the broker would say don't bother sending an LOI in. So I've kind of stretched this deal as far as I can. The only thing would be digging into other types of upside, operational upside. For instance, in this one, I know that water and sewer currently is paid by the landlord. In South Carolina, you can implement RUBS. So we look at utilities, 58K, maybe you capture most of that or 80% of that, call it 40K. So maybe your other income can grow to 60K. Maybe you know that you've had really good success with the quality of your renovations and that you can get better rent. So maybe you kind of you bump your rents a bit. But again, these are all things that as you're doing them, know that you're more finding the boundaries of the deal than saying I'm committed to this thing. Okay. You're feeling this deal out as far as what would it take for it to work. I don't like to look at a deal and say, no, it doesn't work. It's going to work for somebody. So trying to understand under what circumstances it would work, I think is still a useful exercise. So I've gone through here. I've bumped rents to kind of $50 over what my initial projections were. Looking at my vacancies, I wouldn't want to go too much lower than that. Looking at my debt, my interest rate, my LTV, I think they're all pretty straight down the middle. And our IRR has kind of bumped into the range where we start to want to see it. My unlevered yield on cost, again, if you're not familiar with that, no problem, 6.5. 7% is great, but honestly, in this market, 6.5 is really rare as well. So it's like, okay, this is this is what this deal would need to look like for it to work. And at this point, but again, we're still at the $9 million purchase price, which is quite low. But at this point, I might call the broker up and poke and prod at maybe some of these assumptions. Maybe get the sense of, hey, any existing offers, what's the reception been so far, to know if feels pretty confident he's going to get asked, or if he's starting to be a little soft about, being willing to come to the table and whatnot, to know if a $9 million LOI is even worth submitting. But at least I have a framework within which I can discuss the deal, and based on the feedback from the broker, maybe this is close enough and the feedback is promising enough that I go on site. I'm going to really dial these numbers in. This is kind of what the final state looks like for me as far as first pass underwriting. It's getting to this point. I've got the baseline. I know my upside. I know what I think it'll take to get to that upside. And I know at what price and with what deal structure it would work for me and my investor expectations. And it's really a good slate of things to walk away with from first pass underwriting. Okay. So that's kind of my run through. Hopefully it was concrete enough that it was useful. There's certainly much more you can do. You can spend an hour in every OM. They are very interesting, especially if you're a real estate nerd. But in general, you like to have some ability to quickly go through, hit 5 or 10 points of every deal, know what's important about them, put them into whatever your tool of choice is, and from that, know how you're going to proceed.
Ryan, thank you. This was amazing. I think for a quick and dirty, this was definitely more than enough. And I think you've covered a lot of important touch points for the initial touch-up. Folks, again, feel free to unmute yourself to ask questions. In the meantime, so I want you kind of touched upon it, but let's just cover it a little bit more. So if brokers' numbers way too off from what you're finding out through your research, what do you go with in that case?
So the question is, if the pricing guidance is way off, what the next step is?
Mm-hmm.
So depends on the broker. If it's just a Cushman Wakefield mailer that I got and I don't have any personal relationship, I'll leave it at that and I'll move on. If it's a broker that I do have a relationship with, or I want to build a relationship with, I'll give some sort of feedback. Usually I'll try to call them to kind of further the relationship, but I'll call them up and say, hey, really like this deal. I think you're going to do great. Here's where I was and here's why. This was the main factor that kind of prevented me, right? Maybe it's the rent growth. Maybe it's what the renovations would cost. Lay it out there, what your assumptions were, what your major assumptions were. They may have some really valuable input. Like they know that area. Yes, they're going to be a little optimistic with, it's their job to kind of sell the deal, but they're also a very, very valuable source of information. So at that point, I'll kind of lay it on the table and see if I hear anything that makes me willing to adjust some of those numbers, and maybe it gets me a little bit closer. Maybe they do want me to put an LOI in, right? So even if I don't think I've got a good shot of getting it, if I can help the broker out, help them with setting expectations for their clients, then that's a good thing, and it furthers that relationship.
Sounds good. Thank you, Ryan.
Mm-hmm.
We got the question. It's more or less generic. It's not directly related to the analyzer or to you, but basically Christopher is asking, what are the best real estate syndication underwriting training programs? I'm sure everyone has an opinion on that, but there are so many programs.
There are definitely, I've seen a lot of coaching programs which are very expansive, and they provide networking opportunities and capital raising opportunities and whatnot. And within them, there's underwriting courses. I don't know of any underwriting courses specifically that just kind of focus on that aspect of it. I don't know if you do, Alina.
Well, I'm sure colleges that have real estate as a major offer some purely underwriting courses that you can take. But yeah, as you said, all of those expensive coaching programs do offer underwriting training. And other than that, to find something that's inexpensive, you have to buy a pre-recorded course essentially, and that's self-guided, where you do not get any coaching or any support. Go through it yourself. That's the only option.
Yeah, I'll give a plug for one person I think that comes closest. Lena, I know you know. So Rob Beardsley at Lone Star Capital does a lot of YouTube videos around underwriting. He'll take a particular topic and kind of drill in deep, and he's got his own model, which I believe he makes available for free. I think he has a book out recently as well too. I don't know if he has necessarily a program or series of videos, but his content is good, and I really appreciate the various modeling scenarios that he comes up with.
Good one. Well, and obviously Michael Blanc, as you mentioned, his analyzer is probably one of the most popular ones out there.
Yeah, and when you buy this SDA, it comes with a series of videos that show you how he uses it, which is slightly different from how I use it. But that aspect of it is informative. It's not really specific to underwriting. It's more how I use this tool. But that's part of it. So that might get you 50, 60, 70% of the way there. And then you can supplement with some one-off YouTube videos.
Yeah. Typically, practice makes it perfect. So the more you practice, the better you become in analyzing.
I'll throw one more option. I've used on Udemy. I'm forgetting the gentleman's name, but he has a channel with a bunch of pre-recorded courses, but they're extremely detailed and many hours, and the level of that he goes through is enough to kind of teach anyone he has beginner and advanced level. He goes through each particular, like he'll go through the P&L, he'll go through the kind of waterfall on a separate video. So it's very, very detailed, and I've learned a lot from those. So and Udemy has sales where they sell the courses for as low as $25 or something like that. It's like 6 or 7 hours worth of content.
Could you repeat the name again?
I have to look it up. I'll put it in the chat.
Thank you.
Udemy is just a platform, but Matthew is referring to a specific instructor, I guess, who is selling their course on Udemy.
That's right.
Ryan, I really enjoyed your demonstration here and your pro forma and your time. And, when I saw a little over 50,000 per unit, I thought you're going to get it to work. I saw that initially, but I see even after adjustments of lowering it by 2 million, you were up at 86,000 and over per unit. Seems quite high, and moving the rents from 2.25 to 250, and then even bumping up more. You probably do a great job renovating, but I would think that it's just too much for some of the tenants to take that bump, and I think you would lose some people. And it was the lower priced area per household, around 65,000, and there's a lot of expenses these days. So if it was the Strom Thurmond days, the numbers would probably work.
Well, and one thing I didn't show, so my SDA that I was using was, I have various templates, and this was like the value add template, and it actually takes your target rent, your stabilized target rent, which in our case was close to $1,000 average, or 900 something, and it spreads it out and says it's probably going to take you 3 years to fully realize that target rent. A lot of OMs will assume magically in year 1 of operation, apparently you're getting all the rental upside and whatnot. This OM I didn't go into was actually decent. It assumed it would take you about 3 years to renovate and bring up to market. But yeah, the price per unit and the time it takes to get there and the amount of investment it takes to get there didn't work on this deal for me. I'm pretty sure this deal is will trade somewhere around 10.5 or higher. So, I don't know. I don't know what that buyer knows that I don't know. I'm not going to assume they just do a bad job. I'm going to assume that they have some ability I don't have. Maybe they have in-house teams. They can execute turns that are cheaper. Maybe they have cheaper capital, things like that, right? But the market we're in, that thing's going to trade pretty close to ask.
And keep in mind, it's pre-1978, so that's lead-based paint. That's, could be pica with little kids, and that could be the part of the added expense with insurance.
Yeah, there's also aluminum electrical a lot of times in
Aluminum electrical?
Yep. I know for a fact in this property it was remediated, but that's a thing when you're looking at this vintage that you have to be aware of.
Yeah, this guy out in Colorado in Littleton, he had aluminum electric. Cheaper house, much cheaper house, halfway decent size, but it was much cheaper when I was out there, 82, 83, 84.
Oh, wow.
So guys, for those that are interested, Matthew posted the name of the instructor, Justin Cavell. Find him on udemy.com for those that are interested in less expensive course. Thank you, Matthew. Any other final questions for our guest tonight, Ryan? If you guys want to connect with Ryan, he shared his information, so that's his website, Flywheel Equity, and his email. Feel free to reach out to him directly. Ryan, thank you so much again. This has been fantastic. It's definitely helpful for a lot of folks here, as I see that you've covered a lot of questions. So thanks a lot again, and have a great evening, everyone, and we'll chat.
Say goodbye to both.
Thank you. That was awesome. Appreciate it.
Thank you very much. Thanks, Selena.
Thank you, guys.
Thank you again, Ryan. Thank you very much, Selena. Have a great night.
Bye, guys.